One of the key benefits of SRI is that it aligns investors' environmental and social interests with long-term profitability. Investors don't have to choose between being socially responsible and generating a profit. They can achieve both. Investors can use their capital and resources to invest for a better world, both for current and future generations. By investing in funds whose companies are acting in a responsible way, we are encouraging those companies to continue acting responsibly. At the same time, by avoiding companies that are less considerate of their environmental and social impact, this can send a powerful message to the market and encourage management to put measures in place to control their environmental, social and governance or ESG risks. While SRI investors are willing to consider the positive impact of their investment, this isn't to say that they won't expect a decent financial return. After all, this isn't a charity, it is an investment. In fact, since their respective launches, our SRI portfolios have performed very much in line with our growth portfolios and significantly outperformed its benchmark. Notably, the SRI universe of companies has grown considerably over the years. In the early days of SRI, investors had very little choice, with the investment universe comprising mostly, if not entirely, of smaller companies operating in niche areas of the market. It was for this reason that investors didn't expect to receive a financial return and so were conscious of contributing capital to positive change. To demonstrate this point, when the first SRI fund was launched in the 1970s, it was dubbed the Brazil Fund. Not because it was aiming to help save the rainforests, but because investors joked that you would be nuts to invest in it. Ever since then, the investment universe of companies have grown considerably, which is now providing many investment opportunities across a broader range of industries, sectors, and geographies, which are aligned then with individuals' core values. According to research cited by the United Nations and carried out by various other organisations, companies with higher ESG ratings have historically demonstrated lower levels of share price volatility than their lower rated peers. It then follows that these companies have, on average, lower costs of capital. In other words, they are able to borrow money at cheaper rates of interest. Consequently, because of this, these companies have the potential to move into profitability more quickly. Of course, past performance is not a guarantee of future returns, and share prices can fall as well as rise. This is not to say that SRI is without risk. For example, companies may not follow through on their environmental and social pledges, called greenwashing and social washing respectively. Also, there is no standardised methodology as to how companies can report on their ESG performance. However, as more data becomes available, this will allow investors to make more informed investment decisions.